All right, welcome back to the September update of Living Off an Income Portfolio, or cover called ETF. Can you believe it? It's been over a year already. Let me just show you here. So, about a year and something ago, I decided to start posting my journey on Reddit. This was about, I think, a year and 2 months ago. I didn't really start tracking a number, just mainly my own portfolio back then. And then now it's already been a year. It's kind of crazy how far we have come. So this is the how portfolio looked like back then. Honestly, some change, but not too much have changed. You can see the different in margin portfolio have shifted quite a bit. Also, the living expense area also shifted quite a bit as well. Before that, let's jump into the number, and then we'll go take a look at a comparison of these two afterward. So it's been a crazy month, like not gonna lie. I think everyone who's invested in the market can agree that September, when you hear the news, everyone says that it's gonna be a bad month. Historically, it has been underperforming month, but September has been super strong so far. Our portfolio hit all-time high at 1.106. The portfolio is producing about 8% yield or distribution, about $93,000. If you follow in the past, you know that this is the living expense part is where I live off the income. And then the margin account is where I make a little bit more like opportunist bet per se. And then, if I need it, I would take that part out for income. The main portfolio is generally where I reinvest everything and try to, keep it a little bit more like a long-term growth mindset. Sorry, before I get into this, for those of you who joined for the first time, this is a series where I basically documented my drawdown process for my income portfolio, and then I compare it with a lot of popular ETF like VFV, XEQT, and HYLD, and then see how they perform in an environment where we draw down more than traditional 4%. So far for the past year and a half, it's been 2 years now, but I only documented about a year and 2 months. So far, we have kind of hover around 5 to 6% withdrawal rate. So this is our portfolio right now. I think this is basically like as live as it could be. I'm recording on the September 21st. So this is pretty live here. So far, everything is going well. Let's take a look at other portfolios. So this is the VFV portfolio. In August, we sold 23 shares to fund the expenses. EFV right now is hovering at 1,019,000. Every portfolio is starting off at the same amount. I think back in October of last year, that's when I start seriously tracking the number. XEQT is sitting at 1.058 million, which is honestly probably one of the better performer out of the group for sure. XEQT, if anything, this experiment showed that XEQT actually has a very nice growth and also much lower volatility. As you can see, the Liberation Day XQT actually the one that dropped the lowest compared to the rest. Like HYLD and my portfolios are very tech heavy. So when the Liberation Day in April hit, it definitely dipped quite hard. Let's take a look at HYLD here. HYLD is actually edging out BFV right now. Partially it's because of the currency. So VFV is unhedged, right? HYLD is hedged for $2 Canadian. So basically, as US dollar weaken, HYLD actually gaining. And also on top of that, they also have 25% leverage, which enhancing the upside and also unfortunately enhance the downside as well. The unique part of HYLD is that we never need to sell shares. That's kind of like the general kind of like a selling point for the income investing community, that you don't have to sell share ever. So I added this extra function here to kind of net out like what have we sold or bought so far since the beginning. So HYLD actually, instead of selling share, they actually end up having to buy about 3,000 share on top, because distribution is quite high. And generally, we don't need anywhere near that much to live. So basically, any excess, I would buy back the HYLD share at the time. Um, just want to note that HYLD is beating VFV right now, and then how I structure this portfolio is that I'm getting taxed up front, right? So right now, right over here, I basically, as this distribution come in, I tax it right away. I've been taxing it about 10%, but I'm gonna reduce it to 7 because I realized after punching some number, 10% may be a little bit on the higher side, so I'm gonna reduce to 7, just try to balance it off for the rest of the year. So, but honestly, with the VFV portfolio, because you only sell the part that you need. So in tax wise, it definitely has the advantage in that sense, right? So I was calculating if I were to sell about 50,000 a year, the tax that I had to pay on VFV is very minimal, maybe like under 2,000, which is quite nice. Okay, anyways, let's jump to the side by side number. So we start tracking in October of 24, even though the beginning of it is probably like September, October, but I didn't really start doing all these number tracking. Okay, let's move the graph over here. Let's make this a little bit bigger. Okay, as you can see, everyone started at 932,000, and then we withdraw every month at the same time. Um, I know that someone mentioned about VFV X date, so don't worry. I kind of taken that into account to make sure that everything's kind of maximized. So this is the amount that we withdraw so far. So far we withdraw about 47,000 out of every portfolio. Luckily, our main portfolio is beating out every portfolio right now. But I wouldn't draw any crazy conclusion from this. It's just partially because we are heavily weighted in tech, and we all know that tech has been overperforming like crazy. But one thing about being overweighting on something is that you also you're also overexposed to that thing. So if that thing is not doing well, you can underperform, right? But so far it's been doing okay. As you can see here, during the Liberation Day, April here, everything dropped pretty hard, even though it kind of rebounded pretty quickly. But XEQT actually performed really well over here, like these three numbers over here. You can see that XEQT dropped not as hard, but also rebound quite well. It allowed you to have a lower volatility, and that's important to a lot of people. Just make this a little bit bigger. That's important to a lot of people. So in a way, depending on how you look at it, it does help you sleep better at night for a lot of people. Personally, I'm okay with the volatility. I'm still posting during the Liberation Day. And okay, of course, it doesn't feel good posting that your portfolio just dropped by like 200,000-300,000, but it is what it is. That's kind of part of the process, part of documenting everything. And here is our side by side chart. I love seeing data kind of side by side over here. You can see the Liberation Day over here dropping pretty sharply. HYLD actually dropped down to about 700,000 during that time. And the thing is, it's probably dropped lower than that. I woke up, pretty late that day, and then there was a number that I saw, but I'm pretty sure it went lower than that. Our main portfolio dropped to about 732, VFV 753, and then XEQT 766. So it dropped the least, but like I mentioned, could be lower. Okay, so anyways, let's take a look at how it used to look like back in the day, right? So back in, I think I don't have a date here, so probably gonna be about October 24, September 24, something like that. This is how it used to look like. The whole idea is to do the same, right? I meant to live off the living expense portion. Fixed margin fixed income is basically for any opportunity that I see that I want to kind of go in on. This is area where I don't mind using the margin, and then core holdings are where all the tax advantage are, and then everything's meant to be reinvest unless of emergency, and then this is for like a long-term outlook. Think of it as like a plan B in case everything kind of fizzle out and you still can live off that. The idea is that I plug in some numbers. So if the core holding is untouched, and then let's say you reinvest it for 25, 30 years, it should act almost like a traditional retirement portfolio, basically. So let's go a little bit over what the rationale behind each of the ETF that I bought here. So VFV S&P 500, solid one. Not much to say about that. It's good for long-term growth prospects, so I left it in here. TXF is basically a CI tech cover call ETF. One thing different is that it actually equal weight. So basically, it's 25 tech company, kind of like a basically equally weight among all of them. So I think about 4% each for 25 of them. One thing I like about this one is that it's actually been around the longest. It's actually one of the very first cover call ever listed in Canada. But I sold it. So why did I sell it? Okay, you can see here everything is kind of equal weight. If it go up, it probably mean that it hasn't been rebalanced yet. So this one actually been around since 2012, if I'm not mistaken. So quite a long time. Yep, been around 2011. So it's been around one of the longest. So why did I sell it? So first of all, it is because of its equal weight. Equal weight is nice because you're not as concentrated with the Max 7. But for me, after thinking about it, I actually want to be concentrated with the Max 7. So instead, I swap it to JEPQ instead. So basically, I sold out of the core holding. I actually switched it to ZWT, which has a lot higher growth. It pay a lot less distribution, but has higher growth. It's a more tech focus, so I switched to that in core holding. And then I instead I have TXF. I also buy JEFQ instead because it's tracked the Nasdaq a little bit more. It has the most competitive fee in the market so far. And sure, it might not have the cover call strategy might not be as might be closer to the money, but I feel like due to the fee and then how it's been performing, it might have a good longevity to it. TXF will have good longevity too, but I just want to be a little more concentrated. Okay, let's take a look at the next one. So back then, I carry a lot of Brookfield fixed income. These are basically the preferred shares that many Brookfield offer, and these were getting hit pretty hard during the rate hike cycle. The rate hike was so fast, and back then it was like recovering from COVID. People weren't sure that we're going to be going back to the office, or the office buildings are very empty. And then these BPOs are basically a Brookfield office building. It's a debt instrument of them. So they were very shaky at the time, but I look at it like, okay, Brookfield already took over this whole portfolio of Brookfield office. They're not really gonna let it go down without a fight. And also, I feel like it was very overblown. When I bought these one, they were dirt cheap, right? Basically, if you're not familiar with the preferred share, they have usually have a issue value at about 25, and depending on how it's structured, usually it's going to be capping at about 25 depending on how the rates are going. These were trading at about like 10, 12, some even 9. So I end up buying a lot of these heavily on margin at about 11 to 13. I did add to it over time. Yeah, because rate was high, basically as rate decreases, the yield on these is going to decrease, but prices also increase over time. Might not be as crazy as tech, but I kind of get like generally these are, I don't want to say safe, but safer than equity per se. Because you know how when in terms of bankruptcy, bond holder get paid first, preferred share get paid second, equity holder get paid last, right? So in a way, there's some safety net there. So these are doing really well. So imagine like, okay, so I bought these at about 12. I think BN I bought at about 16, BP at about 15, and these are how they are now. They are appreciated quite a bit. Keep in mind that they were paying 15% dividend at a time, and then these are eligible dividend which get taxed at a much more favorable rate. So they went up like almost double and also collecting a lot of dividend at a time. I did sell out of some of them like the BN and BEP because they are reaching the par value which is 25. That's kind of like the ceiling of the prices. So I sold them during May and then flip it over to a little bit more speculative, like more equity focused ETF like YMAC, ZWT again for more growth. And then so far it is appreciated quite nicely. So that's kind of like the rationale of the preferred shares. Let's see what else. Okay, so NVDH, of course, is NVIDIA, right? This one's a harvest product. It pays quite high, but at a time, I just want to kind of dip my toe into it, see how it is. It performed okay. Of course, they're never gonna beat the actual NVIDIA performance because it has a capping cover call. I think I bought this at about 11. Right now, it's at about 12.73 and been collecting about 16, 17% dividend every month. So quite nice. But looking back, I would probably rather buy YNVD from purpose because it has, if I'm gonna go into this one, I feel like that one might have been fitting what I was looking for a little bit better. But so far, no regret. It's okay. Next up is ESPX. This is Evolve. Let me look at the page here. This is Evolve Cover Call Fund S&P 500. When I first bought this, they were paying 7%, and I think along the way they increased their distribution to 10%. Yeah, back then they were paying 15 cents. I think later on they pay about 22 cents. So What I like about this at first is that their fee was pretty okay, right? Because back then they were disclosing fee. I think it was about zero point 0.4, 0.45. And then they only sell cover call on 25% to 33% of their portfolio, which technically should allow more upside. So I choose this over some other name. However, after performing for a while, I find that USCC perform just about the same. So USCC is Global X version of cover call ETF on S&P 500, but they sell 50% of the whole portfolio on cover call. So it's very similar, but I like one thing I really like Global X for, and then I really want to give them props for this is that they're very upfront about their fee. So look over here, right? They would show you, okay, this is management fee, this is expense ratio, this is the trading expense ratio. So USDC been around for a long time, and then the fees are at the time was the most competitive in the whole market. For me, I know that you might say that okay, fees are worth it because they perform well, but if you have the long runway, because I'm quite young, I'm about like late 30s, if you want to be retired on this for like 40, 50 years, you want to make sure that you have the most efficient portfolio possible. So if we can reduce the fee and maintain the return, I would do it. So at the time, I switched it to USCC just because, like I feel like overall the fees are much lower, and then they're very upfront about it. Evolve, I'm not trying to ding them on this, but a lot of the cover call ETF, they're kind of hiding not hiding, but they put the information behind the document that most people not never really gonna go through. So they have they merge a 68.68 and then total is zero point 0.8. So it's quite a bit higher than the USCC, which is it's okay. I know that you're paying a lot higher than the index fund. That's kind of how it is for these things. So I decided to switch to USCC, and then I think about 2 months ago I decided to swap to JEPQ because again, they have the most competitive expense in the whole market, and then YMAC because I want to be a little more concentrated in the Max 7. So yeah, it's quite a change from there to here. Oh yeah, QQQY. Okay, QQY is another evolved one. QQY actually perform quite well actually. Like if you're looking at how the QQY perform against Nasdaq, they actually they're actually beating Nasdaq right now, and then QQY is not even leveraged. So what I did back then is that when the QQY dropped a lot during April, I decided to tax loss harvest. So I sold the QQY and then I buy a similar ETF that's not exactly the same, just to kind of realize some loss and then pick something else. So like I said, I swapped them into JEPQ or SAWT or like YMAC. Sure, some of the JEPQ not gonna beat out QQY, but at the time that was my thinking. But again, QQY expense is quite a bit higher than I would like. Let's just go over here and show you the number here. So QQY is 0.5, but again, if you're gonna go into the full disclosure here, the fee is actually 1.06%. With how they've been performing, is fine, but again, they only been out for less than 3 years. You don't wanna. It doesn't show the whole picture yet because they haven't gone through like a big crash yet. You can, aside from the 2023 or like a flash crash of the Liberation Day. So because the long runway again, you want to make sure that I keep the expense as tight as possible just for the longevity of it. Yep, so that's about it. So back then, 871. Today, this is the final version of the portfolio so far, 1.106. So far, I'm happy with it. We are doing better than S&P 500, but again, no one beat it in the long term, right? I'm just glad I'm doing better now. But then a lot of these are due to concentration and some leverage. So don't draw any unnecessary conclusion. This is just kind of my journey, and I just want to document it just for your entertainment purposes. Um, yeah, I think that's all gonna be gonna talk about today. If you have any question, please let me know, and then I'll see you on the next one.